Hey everyone, and welcome. Today, we're going to tackle some economics questions from the UP PGT 2010 paper. In this explainer, we'll walk through the first 10 questions and really break down the core concepts behind every single answer. So, do you ever find that solving economics questions in competitive exams feels a little challenging? Well, if you do, you are in exactly the right place. We're not just going to memorize the answers here, we're going to understand the why behind them. Let's solve the first 10 questions of the PGT 2010 paper together and really build up that confidence. All right, first up, part 1, demand and consumer behavior. The questions in this section all revolve around the consumer. Things like demand, elasticity, and how people make choices in the marketplace. Our very first question asks, which of the following statements is not correct? Now, according to the paper, the answer is A. But to really understand this, we need to take a closer look at the different types of goods based on income. Okay, check this out. For normal goods, when your income goes up, your demand for them also goes up. That means the income effect is positive. For inferior goods, it's the opposite. As your income rises, you buy less of them, so the income effect is negative. And given goods are just a special kind of inferior good. So this means statement A, income effect is positive for normal goods, is actually correct. This makes the paper's answer a bit doubtful. But what's really important is that you remember these three definitions clearly. Now let's jump to question 5. This one's about cross-elasticity of demand. Cross-elasticity is all about measuring what happens to the demand for one product when the price of another product changes. And the correct answer here is D. And what's great about this slide is how simple it makes the concept. Just think about substitutes, like tea and coffee. If the price of coffee goes way up, people will probably drink more tea, right? That's a positive relationship. Now look at complements, like a car and gasoline. If the price of gas skyrockets, the demand for cars might go down. That's a negative relationship, which means negative cross-elasticity. Simple as that. Here's another really interesting question. It asks, which of these curves does not have constant elasticity? The paper says the answer is B, rectangular hyperbola. Now, this can be a little confusing, so let's take a look at what a rectangular hyperbola actually is. And this diagram makes the point crystal clear. This shape you see, the rectangular hyperbola, is the textbook example of a curve where the price elasticity of demand is constant and equal to 1 at every single point. So, the crucial point here is that, based on standard economic definitions, the paper's answer seems incorrect. What you need to remember is this. A rectangular hyperbola has constant elasticity. It's a straight line or linear demand curve that has varying elasticity at every point. That's a super important distinction to remember for your exams. Our next question ties in perfectly with that last point. It asks what the elasticity is at the exact midpoint of a straight line demand curve. And the correct answer is, it's equal to 1. Let's look at this slide. The diagram shows it perfectly. On this linear demand curve, you can see that above the midpoint, elasticity is greater than 1. Below it, it's less than 1. But right at that center point, labeled here as point R, the elasticity is exactly equal to 1. We also call this unitary elastic. Okay, let's switch gears now from the consumer to the producer. Our part 2 is production, cost, and market. Here, we'll look at questions related to production functions, costs, and how firms operate in the market. The first question in this section is about a famous economic model. How many primary factors of production are there in the Cobb-Douglas production function? The correct answer is 2. And here's the function itself. Here, Q just means total output. And the two inputs, the factors of production, are K, which stands for capital, think machinery and equipment, and L, which stands for labor. It's a fundamental model that shows how inputs get converted into output. Now, this next question might sound a bit technical, but the concept is actually very easy. When a production function is homogeneous of degree 1, it simply means that it shows constant returns to scale. But what does that mean in plain English? So what does this actually mean? It's really simple. Let's say a factory doubles all of its inputs, double the labor, double the capital, double the raw materials. If its output also exactly doubles as a result, that's what we call constant returns to scale. The increase in output is exactly proportional to the increase in input. All right, let's talk about costs. This question is about the nature of costs in the long run. And the answer is that in the long run, all costs become variable. And the reason for this is really key to understanding economics. You see, in the short run, things like your factory's rent or big machines are fixed costs. But the long run is a time period where a firm can change everything. It can build a new factory, sell off machinery, or even shut down the business. So, in the long run, nothing is truly fixed.
And that very concept leads us straight to the answer for question 8, which asks for the formula for total cost. It's a simple one. Total cost equals total fixed costs plus total variable costs. This is one of the most fundamental equations in all of microeconomics. Wow, we've covered a lot of ground in these questions, so let's do a quick rapid-fire recap of all the important concepts that we've just learned. We learned about normal and inferior goods. We understood different kinds of elasticity, like cross-elasticity and midpoint elasticity. We looked at the Cobb-Douglas production function and what constant returns to scale really means. We also saw how the burden of a tax shifts to buyers when demand is inelastic, and that elasticity is what actually quantifies the law of demand. As you can see, these questions often test just a few core ideas in different ways. Truly mastering these fundamental concepts is your absolute best strategy for succeeding in any competitive exam. And as we wrap up, a question for you. When you go to the supermarket, think about cross-elasticity. Or when you get a pay raise, think about the income effect. Which of these economic ideas do you see showing up the most in your own daily life? Definitely something to think about. Thanks for watching.